Hello everyone, welcome back. In this video, we are going to discuss about various kind of gaps in the market. Now, in the market, gaps are very important points. A gap is created when there is a gap up or gap down opening. But what happens is that if there is a gap up or gap down opening also, during the course of the day, the gaps may be filled. So, when we look at a daily chart in specific, we refer there is a gap when we see that in the case of an up move, if we find that yesterday's high and today's low are separate, that means there is a gap between yesterday's high and today's low. Similarly, in the case of a down move, we will refer a gap is created when there is a gap between today's low and tomorrow's high. So, there would be gap. Now, gap are very important from the point of view how the market behaves after that. How the market behaves or shows price action after a gap is created, then it defines the way that the market may be acting after the gap is created. We have categorized the gaps in various classes. The first of them is the common gap or a pattern gap. A pattern gap is like, suppose we see that the market is within a range. Then during the course of price action, if a gap is created within the pattern itself, then the gap doesn't have much significance going forward. So, the pattern gaps or common gaps are generally ignored for the purpose of longer term trading. Now, then there is a breakaway gap. What is a breakaway gap? Suppose the market was within a range. Now, there is a gap created and the market moves up. In the reverse direction also we can find this phenomenon. There was a range, and suppose after that distribution or consolidation, there is a gap down candle and eventually market moves lower. So, those gaps created in the upside or in the downside also, which break from the consolidation range, those are called breakaway gap. Then comes the runaway gap. In the case of a bullish up move, often we find that a gap is created, market is moving higher, and a gap is created and the gap is never filled actually, and the market moves even higher. Similar things happen in the case of a down move also. The market was already moving lower, a gap is created and then the market moves even lower. These are called runaway gaps. Now, the last kind of gap that we are going to discuss is the exhaustion gap. Now, suppose we are already in a big up move, the up move has played out for quite a long period of time. Now, there is a gap created in the market. What happens after that is that the market goes a little bit higher, and then after one or two candles or in the same candle itself, the gap may be filled and eventually the market moves lower. Similarly, in the case of a down move also this can happen. After a big down move, what may happen is that a gap is created, but the market doesn't move much lower. Eventually, within 1 or 2 or 3 or 4 candles, the market eventually reverses and goes higher. So, those gaps are called exhaustion gap. So, the way the price behaves after its gap is created, it can give us very useful indications about the market directions going forward. Now, let us look at few of the examples. Let us look at the chart. Here, we are looking at the investing.com charting solution, that is the web-based charting solution, and here we are looking at daily chart of Nifty. Now, see, initially the market was within a range. Now, there were few gaps created within the range itself. So, these are particularly called pattern gaps. Now, then there was a range breakout and we can see that the market moved higher and this gap was never filled. So, these are basically breakaway gaps. In the course of up move, we will see many gaps which are again never filled and the market moved higher. So these are basically, these gaps are actually runaway gaps. Now when we talk about this gap, we can see that this gap was actually filled within some candles and eventually the market moved lower. So we have seen that this exhaustion gap actually, as it was filled, showed us that the market may move lower, and the market actually moved lower. Now let us look at the Nifty in the latter stage also. Here also what we could see, that the Nifty was within a double bottom kind of a consolidation. Then see, there was a breakaway gap. Then in the course of the movement, we can see that there were many runaway gap or the breakaway gaps that were formed. Now as we can see that in this small up move also, there were many runaway gaps. There were many runaway gaps created during the up move. But see here, what happened is that after that up move, this gap was actually filled within next few candles, and this was an indication that the market may move lower. So this was an exhaustion gap, right? Let us look at the Bank Nifty chart here. In the downside, we can see the examples. Here what you are seeing, that this was the breakaway gap after this consolidation, and see, this was a runaway gap that was formed. There were many runaway gaps that were formed during the down move. Now look at this gap. This was again a opening in the downward direction, and after that the gap was filled within the next two candles, as we can see, and eventually the Bank Nifty moved much higher. So here in the Nifty and Bank Nifty charts, we could see how gaps help us in guessing or predicting the way the market is going to behave. Gaps are very important. So it is all about gaps in this video. Thank you for watching it.